Hey guys, and welcome to a new educational video. In this video we're gonna talk about liquidity as per my initial thread I wrote back in 2021. I'll link the Twitter thread below so you can also read with me. So we're quickly gonna go through 3 points that are most important when we talk about liquidity. So first, what does it mean in the context of trading? Why is it relevant? And what scenarios can we expect and how can we implement it in our trading? So first off, what is liquidity? Well, it can have a lot of meanings, of course, in the language of English, but in this case, we're mostly referring to, in this case, a high volume of activity in a market. So what does it mean? Well, we're gonna go to the chart and we're gonna show you. So what do we mean in this case with liquidity? Liquidity is usually where the market wants to head to because, for example, big players tend to want their big orders filled and they tend to look for liquidity to do so. So in this case, we had a wick up here, and you can assume when price starts trading here, everyone that's shorting will likely position their stops somewhere in this region because they're like, okay, if it breaches above this previous high, then my idea is invalidated, so I'm gonna put my stop somewhere in this box, most likely. And that will also mean that if price were to reach this point, that a lot of these short stops will get triggered, which causes buying. Additionally, there's also people that are buying the breakout, which also causes a lot of buying. So let's say you are like a big whale or a market maker or whatnot, and you want to fill a lot of cells or you need to get rid of supply. Well, if you do it here, while price is already kind of rejecting, you're just gonna cause a huge dump and you're not gonna get an ideal price. But if you were to push, for example, price above these highs, knowing a lot of short stops will get triggered and breakout traders will come in, you can likely just sell or get rid of a lot of supply in this little wick here, because all this buying that's being created at this level. So that's why you often see these wicks of previous high before actually rejecting, which we can see here. So here it might look we would roll over, but instead we took the high once more. A lot of orders likely got filled here, and then price actually rolls over. And I took here the period right around the Bitcoin ETF, as it was a lot of news-driven price action and just a lot of choppy sideways action. So what you can see here is all these red dotted lines are basically liquidity grabs, which turned into a quick bounce afterwards. So you can see here's the low, likely a lot of stops below it. Here we can see the stops get triggered and we tend to get a reversal. But that's not always the case. And that kind of depends on two factors. Basically, when we're ranging, usually you see a reversal after these wicks, which get taken out. So this is a really big one here, for example. This was, or these were the main lows. This one got front run actually, but a lot of stops were likely placed below here during this entire period. We came down, we sweep the lows, and we bounce straight back up. That's what you tend to see a lot during choppy price action. But in this case, of course, here we have this breakout finally, which happened a couple of weeks ago. So yes, sure, this could have rejected, but in this case, price didn't because there was plenty of volume, plenty of actual buying without just a wick or like stops being triggered, and therefore price continued higher and higher. So how can you implement this in your trading? I'd say it depends on your trading style. Let's say you're scalping, then these kind of moves here, just buying into these wicks once they start retracing can make for a good move, good quick move. But always be aware of what's actually happening. Does it make sense if price rejects here? Let's say we've been ranging here for a while. In that case, I would favor that we, once we see a wick and we retrace back up, that we actually see a reversal to where price came from. But if we're strongly trending, like we are here, for example, you can see if we zoom in a bit, here we have a lot of these highs which are just continuously getting taken, And yes, you get a small reversal, but in the end, price just keeps going and going until the eventual real breakout. And shorts are trying to short this every time. So they likely short, they're slightly in profit, but then price doesn't roll over and it just keeps going and going and going. So in this case, there's just a lot of shorts being trapped every time at these highs, even though price has no reason to go down just yet, or at least it doesn't want to. And these shorts just tend to keep getting run over. And that's why in strong trending markets, I'd say these swing failure patterns, which these are, these wicks above the highs into a reversal, these tend to not do too great. But if you get like a clean range, for example, or like this kind of price action, then yes, you can see here, if you were to buy up these deviations below here, for example, you could get for quite a few nice moves, and the same here towards the upside. For example, I think a lot of people probably traded this, which was pretty clean. So we, depending on how you draw the range, of course, I see this is the range low, this is the range high. This would have been a decent deviation to trade because it took the liquidity below, took out all the stops of this region, it actually retraced back up, so shows some kind of reversal, and then at some point it did hit the range high. And at the range high, we rejected. So this could have been a short upon breaching back below this range high. We actually touched the range low as well, and that could have been a nice quick trade here with little to no risk in this case. Obviously, this is in hindsight, so it worked out well. But in this case, you can actually define your risk pretty well upon entering when it retraces back into the range, and you could have taken a trade similar to this. So I hope that cleared it up a little bit. Like I said, I will put the thread below, which the initial thread was about, like the liquidity and the examples in there. One more thing is something I want to show, like on these higher time frames, this can be the case as well, and we tend to see this on these coins that have been trending down for a long time, and then you have all these lower highs sitting here, and some time when finally price starts reversing, it tends to be a really quick move in this case. So you can see here Coty basically retraced the downturn of like the past 2 years in a matter of a few weeks, simply because in this case we didn't get a reversal every time we touched these highs, but one high turned into the next, and especially here you can see it started accelerating once it started cutting into all these previous lower highs. So I think it's safe to assume that some short stops were likely positioned above these levels, and then one squeeze turned into the other, and so that way you can see how it just snowballs back up and up and up. And yeah, those can really cause some really volatile moves in this case towards the upside, but the same towards the downside, of course, when you have slightly higher highs, which are, higher lows, which are continuously getting broken, and then one can turn into the next, and you get this big squeeze downwards. So with all that, I hope that made it a bit more clear, trying to keep this one a bit shorter. But yeah, just figure out what works for you, and if there's any questions, of course, let me know. Take care and good luck out there.